Global slowdown is beginning to bite into FDI, or foreign direct investment, into China. FDI dropped nearly 3% in the first half of the year. In June alone, foreign direct investment dropped 7% to only $12 billion US dollars, but the Ministry of Commerce is not concerned about the recent drop.
The drop of 3% in FDI in the first 6 months is mainly due to falling investment in the property sector, which is the result of macro policies, and we cannot say it's a bad thing.
China's economy isn't alone in facing challenges to growth. Uncertainty also looms for the U.S. economy as well. Joe Minarik now joins us for more. He's a Senior Vice President of Committee for Economic Development. We're also joined by Nils Overdahl, a portfolio manager with New Century Advisors. Gentlemen, thank you very much. Nils, let's start with you. The Bernanke comments on Capitol Hill in front of the Senate Banking Committee. We've heard this talk before. Why was it different this time, and why did we get a bigger reaction from the markets?
Well, I'm not sure that it was different this time, insofar as we heard the chairman reiterate what was told to us in the press release on June 20, largely what we have seen in the minutes. But I think he's breaking it down and continuing to make a commitment to assisting the markets if needed. And he's also showing that the Fed is beginning to downgrade their growth expectations, their inflation expectations, and I think what that begins to do is create an environment whereby he's making the case for more stimulus if needed.
The markets have reacted in a very funny way over the past couple of these Q&A sessions with the Fed chairman, and every time we're always looking for clues that perhaps he may or may not hint at QE3. Are investors watching the right things?
I'm not sure they are. We're concerned about where the economy is going. As a result, people want to see action, apparently, on the part of the Fed. Not clear that QE3, depending upon its magnitude, is going to be enough to make them happy ultimately. It seems like one of those things where really you've got a little bit of shadow boxing going on between the Federal Reserve and the Congress. The Fed wants the Congress to carry the ball.
And to be fair, it's not just here in the U.S., it's in China, it's in Europe, it's in the U.K. Every time we see some weaker than expected economic data, the first thing the commentators usually say on television or radio is, well, might the central bank take further action to stimulate the economy? And I wonder, have investors and the portfolio management community, have we been addicted to moves by the central bank?
Well, I'd certainly like to say no from the perspective of the folks at New Century Advisors, but I do think that a lot of the markets have become overly myopic, looking for the next trace that there's going to be some sort of stimulus. And in reality, I think where the markets get it wrong is that you can see that back in 2010, yeah, you got a pretty big jump and a pretty big move in commodities, equities, rates from the first round of quantitative easing, but you've really seen diminished returns since then.
And Joe, to be fair, I mean, for both gentlemen, we're here in Washington, D.C. It's a very, very big political year, and every time we get these economic numbers, whether it's on the economy or on the jobs, it will be politicized. With that in mind, by the end of 2012, where do you see the economy in terms of where we end up?
It's a pretty dangerous situation precisely for the reason that you mentioned. There's something like a consensus that we need action in the near term to try to buck up the economy, in the longer term to deal with the fiscal imbalance, which provides you with the security so that you can take the short-term action seriously, but the two parties are just in no mind to compromise.
That would be the common sense approach, but Nils, the investment community, they have to also start looking at the potential consequences of this so-called fiscal cliff, the inaction or the inability of Congress to come to terms or come to agreement. How do you manage that in the portfolio in terms of risk?
Well, I think those comments are critical, and you asked the right question, because what that's creating is general uncertainty in the markets. It's general uncertainty at business, cash on the sidelines. But what that does create for an investor is if you can begin to look away from just pure business fundamentals, economic fundamentals, and you begin to look at the world in which we live, politics are tremendous, and the fact that this overhang is there, that uncertainty creates an investment opportunity when you look at stuff like corporate debt. That combined with the easy money, the ease of rolling over debt, and the conservative financial management teams at these corporations creates an interesting opportunity with regards to just companies that are able to access financing, strong corporate fundamentals, but also running very conservatively. It's not great for the economy, but it's can make for a good investment.
Let's take a step back for our global viewers and for our viewers, of course, in China as well. When we talk about the U.S. economy, the first question they would generally ask is, how does it affect them, or how does it affect the global investors as a whole? And we can't ignore what's happening in Europe as well. So I'd ask each of you, gentlemen, how does it affect the global investor?
We're looking at both finance and economics. With respect to finance, if we have another stumble, we have more financial institutions that have problems, you have asset markdowns, and those, of course, cascade throughout the financial system. But beyond that, the U.S. economy has become more reliant on exports, and that, of course, means a vulnerability if other parts of the world become less vibrant.
Nils?
Well, and I think the U.S. is an important component of the global economy, obviously. And what you've seen over the last several years is we've had a debt-fueled sort of growth pattern here. And we've come to the end of the rope on that. We've got consumers that are overwhelmed. The corporate sector is running very conservatively. And I think that for the global economy, you have to begin to reevaluate growth expectations if, in fact, you're relying on the U.S. as a consumption engine.
And that's exactly what the IMF is doing. Gentlemen, thank you very much for your assistance and analysis on what Bernanke, the Fed chairman, has been saying.